Good evening, people. Good night, good morning, wherever you're watching this transmission. I got a really good article here from Zero Hedge. Good old Tyler Durden has got something to say here from Zero Hedge. Remember what Tyler said in the movie Fight Club. It's the things that you own will start to own you. So all these possessions that you own end up owning you. And that is very, very true. We know it's going to be painful. Half, not 1/10, half of Canadian mortgages are up for renewal in 2018. And when commenting last week on the latest troubling trends in Canada's housing market. Trends in the housing market, guys. Don't forget to join me every Wednesday, 7 p.m. Tijuana time, 7 p.m. LA County time, 7 p.m. Vancouver time. That's 9 p.m. Miami, New York, Toronto. And I think I forgot what time it is, but I know in Australia it's like noon and noon the next day, Thursday, and 2 p.m. in New Zealand. So I think, just check your local listings. Anyways, when commenting last week on the latest troubling trends in Canada's housing market, we predicted that, unlike previous forecasts of Deutsche Bank's Torsten Slok from early 2015, who at the time said that Canada is in serious trouble. This time, the moment of truth for Canada's all-important housing market was indeed at hand. Here's a graph here. Canada's household high debt-to-service ratio, chart 3. The BEA Federal Reserve Statistics Canada household debt service payments as percentages, disposable personal income, and seasonally adjusted last data point Q4 2016. So that's not that old. That's actually very good information being in 2018. That's actually at Q2 in 2018. This is actually really good information here. The reason, while it had taken banks some time to push up their mortgage rates, they were finally catching up. And as Bloomberg reported, just in the past few days, Toronto Dominion Bank, Canada's second largest lender, lifted its posted rate for 5-year fixed mortgages with a whopping 45 basis points to 5.59 as government bond yields touched their highest levels since 2011 this week. It's a big move, the biggest move in years, said Rob McAllister, founder of RatesBuy.com, a mortgage comparison website. As regular readers are well aware, rising rates in Canada has often been cited as the catalyst that could and would burst the country's housing bubble, because Canadian households, unlike American ones, never managed to deliver. Canadian household debt well above U.S. peak, chart 2. So this Canadian household debt. BEA, Federal Reserve Statistics Canada, BIS, household debt as a percentage of disposable personal income, seasonally adjusted data point Q4 2016, which is somewhat good timing on this. Q4 2017 numbers, you won't be getting anything at least for a good while, some good solid numbers. Well, good unswayed, unmotivated, unmassaged numbers. Canada, United States of America, look at that. And then remember the huge housing crisis right here. Oh, let me put the mouse over it. The huge housing crisis right here. Pow! 2008, cacao. And everything came down. I like to see it as of today. It'd probably be up here somewhere. And even modest increases in rates would have adversely cascading effects. And while Toronto Dominion was not alone in raising key borrowing rates last week, it was joined by all of Canada's biggest banks, just as the busy season for residential real estate gets underway, gents. Remember, guys, I have a grade 6 reading level, so please, bear with me here a bit. The message is important. Don't worry how it sounds. You understand the message here. A more troubling development is taking place in the mortgage market, which according to Bloomberg is set for particularly heavy year of renewals in an environment where debt servicing costs are already soaring at the fastest pace in decade. What happens next is anyone's guess, but the answer is critical, as it will determine the severity of the recession that is now virtually assured to hit Canada. The economy has never been as leveraged as it currently is, and the economy is far more interest sensitive than it has been in the past, to a degree that we don't have certainty over how each interest rate hike is going to affect Canadian consumers. Francis Donald, senior economist at Manulife Asset Manager, said by phone from Toronto. All we know is it's going to be painful, but how painful isn't quite clear. As Bloomberg notes, a heavy household debt burden is perhaps the key reason that central banks has been reluctant to raise borrowing costs further. Remember, guys, they need to raise borrowing costs. Something needs to prop the economy. Do you remember, guys, when we were talking about this? We're not fabricating. We're not exporting. We're making a tire. Oh, we just made this. No, we're not doing what we did in the early 80s, okay? This has gotten to a point where our GDP numbers are all swayed around or massaged to help sway the discussion and calm investors, right? After hiking interest rates 3 times between July and January, given the nation's debt load, as of February, households had a record of $2.1 trillion and $1.6 trillion of mortgage and non-mortgage debt. Pelosi estimates the economy is 50% more sensitive to a rate hikes than at any time in the past. And yet, the banks appear to have capitulated last week when, one after another, they all hiked key mortgage rates in rapid succession, akin to the infamous selling scene in the movie Margin Call. The bank knew it would launch a financial crisis by being the first to sell, as it would force the world to financially admit the emperor was naked. If you guys remember that. Now it's Canada's turn. Oof, Canada, what's going on here? And here's why. Canada will no longer be able to avoid the troubling reality of rising rates. The country is entering a period in which no less than 47 points of existing mortgages need to be refinanced this year versus 25 to 35% typically, according to Lan Pollock, head of North American Rates Strategy at CIBC in Toronto. Hey, I got a conspiracy theory for you guys. Do you honestly think that they knew half the rates were going to have to be refinanced in 2008 and said, right there, boom, raise it now? It's like watching a stock. You know, you're watching a stock, it's going up, you're watching it live. I used to watch stocks live all the time. Watching, should I sell? Should I sell? Boom, it trickles down just one bit. Sell. And then it goes up another. But no. Are they looking at when to raise the rates? When the debt load gets all the way up there, just like the stock gets all the way up there like that graph showing, and then they decide to say, push the button now, push the button now, let's go. And, you know, yeah. Worse, the rifts will take place. The rifts will take place smack in the biggest mortgage interest increase in over a decade, just as the country's biggest banks are rising key mortgage rates. To be sure, as we reported last week, Toronto Dominion kicked off Thursday, hosting a 5-year fixed mortgage, 45 basis points at 5.59 points. Oh my God, that's like $6,000, $7,000 a year to finance $100,000. Oh my God. And then to finance $1 million, you're looking at 70 to 75 large, with less, like $68,000 to finance 5.59% in $1 million. You will take on a 30-year On a 48-month term, 30-year amortization, you're looking at, I'm just trying to think off the top of my head what the numbers would be. Man, after a 5-year term, you're still going to be left with $908,000 roughly after a 5-year term if you have a $1 million mortgage at 5.59%. So you're still going to owe 900 and I think it's 28,000. That's a lot of money. That's even more. You're going to owe almost 950,000. Well, no. I got to do the math on that one. That's a big number. So Royal Bank followed with its own hikes on Friday. Even worse, new mortgage stress tests are pushing some borrowers from the big banks to alternative lenders and charging higher. Yeah, you know what, guys? I've been hearing from boots on the ground. There's people going to secondary markets or secondary lending, and they're getting 6.5, 7.5 points. 7 points is huge. If you're even on $100,000, you're paying $78,000, $8,000, $9,000 a year in finance charges on some of these $100,000 loans. So if this is going to affect people with second mortgages, your second mortgage or your home equity loan will go up with it. So you're when you refinance, especially people on variable rates. Oh, I totally forgot. If you're on a variable rate mortgage, you're toast. You are in so much trouble, you have no idea. Variable rates, I told you guys a year ago, 8 months ago, 6 months ago, I've been telling you guys to talk to your bank and say, look, I'm on a variable rate. You guys might raise rates. Go back to 5-6 shows. I've been saying this over and over on trends in the housing market. Guys, if you have a variable rate mortgage, go to your bank and say, hi, what do you guys have for me? What are the rates? Can I switch from a variable rate? I'll pay the $3,000 in docs and appraisals. Yeah, maybe we could get that small credit card and maybe a student loan, and we could incorporate it in the equity and tie me in to a smaller rate. And now the rates are going up. So if you're still on variable rates and you have a second mortgage and you have equity in your house, I would recommend to consolidate if you can. You should have did it before the rates went up. But remember, I'm not a financial planner. I have a grade 6 reading level, and I don't know nothing. But let's continue. No matter who they... Okay, I got that. Canadian homeowner appears to... I didn't read this. Unavoidable. According to Statistics Canada, total payments on debt made by Canadian households rose 6.7% in the fourth quarter from a year earlier, and interest paid component climbed 9.2%. Those were the biggest gains since the financial crisis. A moving average quarter-over-quarter changes shows in similar pattern, which... with the 1.62% increase in the latest period, the fastest since 2008. So it's the biggest quarter, 1.62% increase, fastest since 2008. There it is here. Quarterly change in household debt payments. You know what it is, guys, is if you have a blended rate, a blended interest rate, and when I say that, you take... I'm paying 30% on a Canadian Tire card. I'm paying 16.5% on an HBC card. I'm paying 24% on, I don't know, Wells Fargo. 18% on Bank of America card. And then American Express. You got a blended rate there. So sometimes combining it and paying a bit of a higher single rate makes a bit more sense. But cutting back the amortization so you don't have a million years to pay it off, cutting the amortization to about a 10-year period will be a bit steep. But you know what? In long term, you're better off, right? Let me just take a sip of this juice here. I gotta wet my beak. Meanwhile, as shown in the top chart, debt payments now represent about 14% of household disposable income. The highest share in 3 years. As long as rates keep rising, debt service ratios will continue moving higher as well over coming quarters until tipping point is reached and there is a wholesale interest payment revulsion. The world spends a lot of time thinking about the level of Canadian debt being extremely elevated, but what matters most is not the level of debt Canadians hold, but the cost of carrying. That's what I'm talking. The cost of carrying. That's what I've been talking about. Manulife Frances Donald said, she's right. And the problem is the cost of carrying debt is now spiking. Canadians are going to start to feel the pinch at it. Donald added ominously. To be sure, as we reported 3 weeks ago, the cracks are already appearing, as RBC analyst Vivek Silat pointed out. The roll rates, the percentage of credit card users who roll from early stage delinquencies to 60 to 80, 90. Yeah, once you get 90 day, it gets sent out to plaintiff and dockets and all that stuff happens. Day delinquencies reached the highest since 2008 for one credit card program, while delinquencies for another were above the 10-year average. And while the level of mortgage appears is still low by historical standards, a raising debt service ratio could signal that's about to change. The big question, of course, is what happens if and when the economy, which has never been more levered, falls into an all-out recession. Previously, Canada's economy led the G7 in growth last year, mostly because of the willingness of the country's consumers to spend money, much of it even more cheap credits. So people are riding off the coattails of their equity in their homes and using them as ATM machines. But growth is expected to slow this year. GDP shrank unexpectedly in January, with February, due to the latest Tuesday, another disappointment, and that may be in for BOC's tightening cycle. Meanwhile, lending indicators suggest that tipping points may have already come. Canada's retailers have already had a tough few months. Retail sales in February were still 1.8% below 2017 peak levels. In volume terms, the input used to calculate gross domestic product data, first quarter retail sales probably posted in the biggest quarterly drop since the 2008-2009 recession. Canada bulls hang in the bowl, not balls. Canada bulls hang their hat on the country's still low unemployment rate, which has benefited from rising oil prices and decent economic growth, which should help the economy weather higher rates. Well, the unemployment rate, but how do you believe these statistics? Is it really low? There's a lot of unemployed people I know, like a year off, 4 months, 6 months. Although with ever basis points increase, risks are rising. You have some capacity in the economy to absorb this, but the fact that rates are going up isn't positive for consumers because it's making credit more expensive. Bloomberg intelligence analyst Paul Goldberg said, that's the but. And the economy that has never been more in debt, that is a very big but. A million comments here, guys. So rates are going up, and I was told by a previous caller a few weeks back that they will never raise rates. And I've been telling people not be careful. This is a game. Housing market now is not, it's become an equity. It's become a market as of just like a stock market. It's volatile. Anything that goes up must come down. Housing can't keep going up. There's just no way it's going to work. Once housing is at a normal level, in a normal housing market, it's 4.5 to 5%. So I open this up, okay? Okay, do you guys know when you're booking a flight? Okay, you just go to Google search, for example. You put Toronto to Lisbon, for example, enter. And then it would show you, it already shows you all the flights already without you even going to an airline. And it shows you what the prices are, which ones you could get round trips, or which round trips you could take that are cheaper, which ones are connecting or direct. Well, look at this. I just typed in mortgage. What did I type in? Mortgage rates or best mortgage rates or best Canadian mortgage rate. Boom. It comes up just like it would in just like that. Just like you're booking a flight now. Now look at this. Right now it's featured 3.04%. So this is on 400 large. So 400 large should be what the average house price typically should be like. And that's with a down payment of 60 large, and that's mortgaging $349,000 you're borrowing basically. So you're financing that much, but look at the rates, man. Holy crap. Look at the monthly payments. So now the problem we have is a one bedroom in the city of Vancouver is about, was it $750? I want to be very conservative here. Let's say $700,000. I know it's not cheap. I know it's very expensive. $700,000. You put 15 points down. There's your monthly payment, and then you got the strata. I call it organized mafia. That's why I own free and clear, and that's why I own detached freehold. Everything is just organized mafia. So that's it right here. Organized mafia. Look at that. It's $3,606 a month. But remember the article I read this morning to you guys that affordable rent in Vancouver is now $37. Was it $3,700? Was it 37 or? Or is it news? I think it was $3,700. 3,100. Here it is. 3,702. I was right. Here it is. City of Vancouver now defines $3,702 rent as affordable housing. That's cute. It's kind of sweet. But I want to know, so and then it goes right on par with this, eh? Right on par with this calculation. That's a one bedroom. Let's see what they say about the one. So 3,702 per is affordable. So a 2-bedroom unit. Okay, we're in the same part of the city, or 2,700 for a 2-bedroom unit. Ooh, this is now rates went up. Eee, now rates went up. This is not going to be the same, and this is different now because this article was written the 1st of March. So rates went up a week and a half, 2 weeks ago. Third week of March rates. Mid-third week of March rates went up. Eek. Okay, so let's look at that that house we were looking at. What was that house we were looking at? Oh, that refurbished bungalow in us. Remember that refurbished bungalow? Well, there's a lot of teardowns for about $2.4 million, right? So there's a lot. There's a lot of. I get like this when I count pesos. There's so many. The peso denomination is so high, so you get confused. So that should be right there. All right. So you got to put, for that much of a mortgage, your down payment needs to be minimum 20. It automatically adjusts 20 points down. With a mortgage, you're mortgaging $1.92 million. And that's what you're looking at per month. Yee! Wow, look at Royal Bank. $11,000 per month. That's if you buy right now. But when rates were a lot, when rates were cheaper, obviously your payment was slashed huge. Oh yeah, your payment was a lot less than this. Holy crap, by a lot. Look at this, TD. Look at RBC. A lot of people are tied in with RBC right now. That's huge. 5.34 points. 5.14 National Bank. It's huge. Okay, let's come to Earth now. 1.4 mil. Come to Earth for a house. Okay. Okay, 1.4 mil is very within boundaries. Man, it's still a lot, man. This is I see what's gonna happen is the people that bought in the last year and a half, 2 years maybe, they're gonna be in a bit of trouble because if their rates, well, no, if they bought a year and a half, they still have 2 years till their mortgage expires. But the people that bought 4 years ago, so the people that bought 4 years ago would have paid about 1.1 million, provided they put down, didn't get those government loans. Is that it there? Yeah, it is. So you have 880,000, provided you put down 220 large too. You can do 5% down. So it's still crazy. So the renter's gonna have to either figures, or you're gonna have to. So let's say you put down 5% back in the back in that time. Then they're not even allowing me to put 5 points in there. Wow. And it's a 5-year term. It's 5-year. Variable, oh my god. Oof. Variable's low right now. Bank of Canada rates are still at 3 plus. But they're advising people to lock in. You see how rates are a lot cheaper on variable right now? But fixed open, nothing. They don't want you paying off fast. Let's look at renewing. So this is 350 large on renewing, 20 years. Still kind of steep. Mind you, if you have a $350,000 mortgage, you're not that bad off, right? But we'll see what happens. Refinancing. They want your business. They try and slim the rates down to get your business, right? And home equity line of credit. Oof. Ooh, Tangerine's here. So lines of credit are pretty prime plus 0.5 right now. So I don't know. I don't believe in blended interest rates when you're playing multiple rates. That's just me, right? Don't take my advice because I don't know anything. Let me know what you guys think. I've been talking forever here. And let me know if you saw this video. Sorry, this one here. City of Vancouver now defines $3,702 rent as affordable housing. It's cute. I mean, it's kind of cute, you know. It's something you'd see in a comedy movie, and the person would look, what? It's like, yeah. So let me know. Comment below, and I'd like to know what you guys think. And if you dislike this video, let me know why. You know, just don't dislike the video. Tell me. I need to. I'm not perfect, right? And you know. Oh, someone's commenting here about the Blue Jays. Thanks for watching, guys.